So, winning trading strategy. We were talking about some of these earlier. And in fact, a lot of the questions that came out of just the previous presentation would have been talking about strategies that you want to employ, either to minimize loss, to deal with portfolio losses, or to make more money. So like your strategy of buying 5,000 when the stock goes from 10 to 1, excellent strategy. Alright, and we're going to talk about that. So before I go into it though, I'm going to talk briefly about what it really means to win. I call these winning trading strategies. But what do I really mean by winning? And then we have to ascertain if we are really winning, and we actually did that before, accounting for the fees. So I'm preempting stuff. Right? And then we're going to look at, I will not take you through all of these, but we're going to focus on the one strategy, quote tailing, trading on psychology. We talked a bit about this. I've been knowing where the psychology of the market is. And we're going to talk about trading on earnings. So I spoke about value investing. Value investing and contrarian investing are actually similar, but a contrarian will buy a stock just to go against the consensus. Alright, so he doesn't necessarily do any valuation or anything like that, and he's not necessarily looking to buy a stock at a bargain like the value investor is. He just wants to know that he's going against the crowd and he's correct. One of the most popular contrarian investors is Ray Dalio, alright? And he runs Bridgewater, which is the best performing hedge fund in the world. Alright, so let's talk about what it really means to win. I apologize for the font. I'm just going to read it. So in general, winning means coming out on top. But in the stock market, you decide what winning is. What do I mean by that? For me, winning is making 30% on my money every year. To another person, that might be unambitious. Because if you are not doubling your money, then you don't think you're winning. Alright? And that's again based on different person's psychology and based on their investment philosophy. A value investor can afford to make only 30% on their money just based on the frequency of the trades that they're doing. They're probably making trades, probably one trade every year, and all he's looking to do is to create compound interest. So I start my value investing journey with $100,000. And I have the target of reaching $1 million, $1 billion. I can use the compound interest calculator to tell me how long it will take me to reach that target, provided I know what returns I'm making per year. Alright? So, I say that to say, in the stock market, you win simply by meeting your target. If you define winning as that, then it makes your investing far easier and you're less susceptible to the emotional swings of the market. So for example, I had invested in, what was it? People just started talking about MPC Clean Energy. In January, it was trading at $140 something per share. Not January, but February. And again, I have articles about these things, so I can share them with you guys. I intentionally didn't put as much in the group because I really didn't want to overwhelm you. But given that we've been through this now, I can now share articles and point you to what the reference is in relation to. Okay? So, I bought MPC Clean Energy at that point. I was willing to wait on MPC Clean Energy for, 5 years because I understood what the company was doing. And in fact, I was more emphatic about MPC than Wipton. Again, a disclosure, I didn't buy Wipton. That aside, if you had bought Wipton, some of you would have doubled your money, and some of you are still up 80+%. So what is winning for you? Is it 50%? Is it 30% in a month? I know somebody whose definition of winning is making $1 million out of the stock market every week. Yeah. I was actually going to have him here today, but he had another engagement. He does. Yes, he does. But you can, alright, so what are some of the considerations you think that would make this person's situation far different than the average?
Capital.
There you go. Yes. This is a very wealthy person. So he is not looking to make, in fact, some of the trades he makes, his exit points are 10%, 15%. And stocks do move that much in weeks. So it's quite easy for him to, yes, me. Mixed philosophy. He's an opportunist. What he does is he looks at the companies that have lost the most in the previous week, and he tries to assess whether or not there is anything that would cause the price to rebound. And where he finds those, he makes those trades. Does that make sense? It doesn't require a lot of smarts, does it? But that's his strategy. And he does meet his goal. So again, define for you what winning is, and I don't want to belabor the point, because I've already gone through this. So the last thing is that really, if you're going to say you're competing, you really can't compete, because there's always going to be somebody who does better than you, and there's always going to be somebody with more funds than you. So let's say you define winning as making $1 million, right? If a person makes 1.5, then really if you're comparing on that basis, then you wouldn't have won, right? But if, however, you stopped your definition of winning as I make X amount of percentage in X amount of time, then you're pretty much good to go. And wild swings like Fontana's 400% or the labs 300+% won't really matter to you, even if you're only making 30%. Alright? Let's move on. So we talked about this. Are you really winning? Do you consider transaction costs? Do you consider the fact that you don't really have that much control within the markets when you're buying stocks? Do you consider that the more frequently you trade doesn't necessarily mean that you're getting better at trading, because the circumstances are always different. 1 minute in the stock market today is not the same a minute from now. Alright? And even when you see situations repeating themselves, because there are so many players in the market, you have no guarantee that a trend that you may have observed will continue. Okay? So it is good to have, again, this is where your investment philosophy comes into play. Lastly, the more frequently you trade, the more your broker makes. And that's regardless of whether or not. Anybody watch the movie Wolf of Wall Street? The premise of the Wolf of Wall Street is that we don't care whether they're buying or selling. Once they are making transactions, we're taking home commissions. Alright? Sorry? Okay. Okay, moving on. So now, the trading strategies employed by winners. We talked about, I think we just now touched on all of them, but let's get into the details of them. Switch. And most of these are actually from books that I've read, so they are not original ideas. And if you want to get better at employing these strategies, the book recommendations are all here. Alright? So, this is Peter Lynch. Peter Lynch managed the Magellan Fund, which was the best performing mutual fund in the United States throughout the late 1980s, early 1990s. Alright? They were doing consistently 30+% per year, even though the market was only returning on average around 8%. Alright? The idea behind the, and I'll move on. The idea behind the one-up Wall Street strategy is that you, regardless of what industry you are in, you have some expert knowledge that the brokers don't. And I'm going to use a case study of Elite Diagnostics. And it's a personal one for me. So, Elite Diagnostics came to the market in 2018. I think it was early 2018 that they did their IPO. When they did the IPO, I think they came out at $2 or something per share. Again, don't quote me on that. I don't remember the exact figure. However, Elite Diagnostics stock remained flat. Remained flat. This is April of 2018, right? The IPO was February of 2018. And you can see here, this is 3. The stock basically remained flat. A lot, because Elite Diagnostics is our radiation oncology. They are a diagnostic imaging company. Not a lot of people understand diagnostic imaging or how the company operates. Because my background is in medical physics and electronics, and because I worked at iSense, and because I had Elite Diagnostics as a customer whilst I was at iSense, I fully understood their business. I knew that they had initiatives to expand. I knew why they were. So having known that, I invested in Elite Diagnostics. I had specialized knowledge about the company. Alright? The average person, and is there another example I could draw? How many of you really understood, say, Wigton fans? Alright, so I'm going to 2 people that I know have specialized knowledge about Wigton. Javon, because he's an alternative energy graduate, and Nathan, because your master's is in alternative energy, right? Specifically him, and I know of 2 others. So they have specialized knowledge, and so their take on Wigton might be a little bit different than the consensus. All right? So, all right, 10 minutes. So that's how you're able to get one up on Wall Street. Anybody know what somebody mean when they say them one up here? Mean them have something over it. So even in investing, you will have specialized knowledge. I coined the term knowledge arbitrage. Meaning you know something that almost everybody else doesn't know or doesn't understand. And so you can take advantage of that by investing in those companies. Warren Buffett calls it your circle of competence. So he advises that you invest within your circle of competence. And there are people who make millions and billions of US dollars trading in and out of 5 or 4 stocks because they are within their circle of competence. So what do you think they do? They buy when it goes low, if the fundamentals are strong. They sell when it goes high. They sit and wait till it goes low. Buy it again with the same money, and they, by doing that 5, 10 times, you create compound interest. Does that make sense? Yes? Oh. So, by the way, this is what happened with Elite Diagnostics the first year. So the revenue improved by $107 million to $404 million, coming from $227 million. The gross profit grew to $278 million, which was a $98 million improvement from the year before. Notice, however, that throughout all of 2018, exactly, what was I doing? I was buying this stock. You're most correct. This is the 2019 report. You can't see it, but it reads, the directors are pleased to submit their report and audited financial statements for the year ending 30th of June 2018. Right. The following are the highlights. Revenue is 279 million. So actually this one precedes This one, but this is for 2019. So, not to belabor the point, but think about where you were, think about what you studied, think about the location that you live in. What can you observe around you that gives you an edge over the average person? And which companies are affected by that information? And then can you invest in that company profitably? And we're going to go back to what is a profitable decision. Putting it simply, you want to buy it at a price you know it is less than what the company is worth. That's a profitable decision because you're already buying something you know is worth more. If somebody wanted to sell you their BMW for $300,000, you would, one, rightfully assume that something is wrong with it. But two, you'd also know that you can probably sell it back for $500,000 just by doing nothing to it. Okay? The next strategy. And the book recommendation here is Rule 1 by Philton. I mentioned Philton earlier. I don't remember in what context. Does anybody know what it means to quote tell somebody? Yeah? You want to tell?
Basically just copy the wrong.
So, as Javon rightfully said, quote tailing simply means following what the big players are doing or what the experts are doing. So, and that's precisely the quote tailing strategy. The case study for quote tailing is NCB Financial Group. I don't know how many of you were involved in the stock market or at least sensitized to it in 2018 or 2017. Yes? About how much was NCB selling for? In 2017, yes. In fact, if you go back to 2014, it was selling for $20. Yeah. Anybody know where NCB is at now? $200, okay. I'm not going to use that far back as the example. I'm going to use something far more recent. In February of this year, does anybody know what transaction was going on within NCB? What were they trying to do? Anybody knows? I'm hearing a lot of that. So raise your hand and I'll... Yes, yes, but that was negative. Yes, that is it. They were in the process of trying to acquire Guardian Holdings Limited, which is a Trinidadian-based company that specializes in life insurance. They are the parent company for Guardian Life Jamaica. Alright? Now, if you are watching the charts, you'd have noticed at some very interesting dates, you would see just some huge volumes trading out of nowhere. So, on average, by the way, these spikes, these bars represent the trading volume. So, observe. Low, 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 spike. Low, 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 little spike. Low, low, big spike. Moderate spike. Low, 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 big spike. Low, 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 big spike. Big spike, big spike, big spike. Alright? In May, January, February, March, April, May. In May of, by the way, notice when this one is. This is in January. This is in February. This is around January, March, mid-April. Yeah, call it mid-April or mid-March. Mid-March, right? Well, you probably can't see it worse than me. So we'll call it mid-March. In May, specifically on May 2nd, I was in Dallas at a conference, and NCB released a notice saying that they had received regulatory approval for the full take-up of the Guardian shares. Look what happened after that. Big spike. If you were watching these, by the way, my mentor and I have been talking about buying NCB from it was at $50, and we have been. We've since exited a part of our position because it has reached our target. Alright? And now we're actually looking at what next to go into. So we're sitting on cash right now. No, that's just our philosophy. You could be in the markets. Alright, just to make that clear. You could be in the markets because there are still companies doing well. And in fact, there are still buy opportunities. I mentioned QWI, which we just bought Friday, because that was an attractive opportunity to us. The stock is worth $1.34, and we're getting it at $1.16. And since then it has gone down to $1.10. So come Monday 9 a.m., I might just put in another trade, another request to buy double the amount that I bought on Friday, averaging down your strategy. Alright? So, following the big boys, following the big boys, you probably could have gone in on NCB before all of this happened. Notice, NCB stayed flat at around 140, 150 for around 5 months before the market responded. And over the span of 3 months, the stock literally doubled. That's coattailing, right? I was mentioning Phil Dunn in the respect that he coattails Warren Buffett. That's what Phil Dunn does. So he just looks every quarter, Warren Buffett and all of the other big money investors are required to, what's the word I'm looking for? Disclose. Are required to disclose what stocks they're buying and in what amounts. So if you know that, you can say, okay, Warren Buffett has been making consistently 20+% compounding year over year since 1950 something, probably knows what he's doing, and you can coattail him. A lot of persons that I know decided not to buy QWI, but they coattail John Jackson. Anybody looks at what John Jackson is doing? I see insider. So you're actually employing a coattailing strategy if you make those trades. And I know for a fact that there are people who have been successful coattailing John Jackson because he's been mostly right. Okay? So that's the case study. And again, I mentioned this about meeting. In fact, we were watching NCB so closely that, I don't know if you know this, but NCB was also stuck in a rut of about $90 per share between 2017 and 2018. And we saw when it actually made the breakout, because somebody traded, I think, 250 units at $125 when the stock was trading at $90. And after that, I think the slide that comes up says live example. I'm going to show you that right now. Price, and somebody was asking me about how you know it was you. So this is what we look at. We look at the volumes trading. You see here, big spike, 64 million. And what comes after? Run up, right? To 216. And you notice it's back down. So let's go from 28, here it is. 99.88. We were watching the stock at that point. I can't show you the actual trade that, well, I could because I have a screenshot, but I have to go to the price. But I'm going to show you the day when it made the 125 move. Come on, 99, and you're going to see the volume that actually moved it to 125. It wasn't a million shares. So we have 95, 96, 113, 1 million shares. 121, 412 shares. And look what happened. I missed the 115 one. But before, exactly before this 113 trade, there was a trade at 115. Notice the stock is trading at $98 on average. So why would you put in a trade at 115? I'm going to tell you why. It's because the Jamaica Stock Exchange has something called a circuit breaker rule. It limits how high the stock can go in any particular day. The maximum being 30% of what the stock was the previous day. So, well, I don't need more for this. If the stock was at $100 the day before, the maximum it can move to the day after is $130. There's another caveat though, which explains why you would put it at 115 or 113 as opposed to 130. Whilst they allow the stock to move up by 30% in a single day, that's the limit. At any point in time, the maximum it has to move is by 15%. So it can move by 15% and then they will halt trading in the stock. A few hours. And then they will release it and it can move by another 30%. But then the stock can't trade at that price or above for the rest of the day. So does it make sense why you would put in 113 or 115?